All right, guys, I'm here with Cathie. We have a whole lot to cover. Before we jump into all the fun stuff, maybe just tell everyone your background and what ARK Invest is and kind of how you guys have built this amazing organization.
Great. Well, I'm happy to be here, Anthony. Thank you for inviting me. I started ARK 5 years ago. We had our 5th year anniversary January.
Congratulations.
Thank you. It's been a lot of fun and a lot of hard work.
No entrepreneur ever says a time, like an anniversary, without taking a deep breath and exhaling. Right? Like, right. All right, we made it 5 years.
Yes, 3 of which I funded myself. So,
amazing.
I was, and it was during the risk on, risk off parts of the market. But I started the firm for 2 reasons. One was to focus solely on disruptive innovation. It's a void in research, I believe, in our market. And I'm finding that the appetite for this kind of research is much greater with the retail investor than the institutional investor. And we're trying to change that. Yeah, it's because institutions are going passive. They're giving up, right? And you just mimic an index and you don't have to do much more than that. That's an oversimplification, but for those who say they're active and are very benchmark sensitive, I think that's just as bad. It's a misallocation of capital. So I felt very strongly about that, and that innovation we needed to support in the public markets, and the opportunities that were evolving were so enormous that they needed to be surfaced, researched. They needed to be shared, these opportunities. And so that was the prime reason. And the second reason was to add new dimensions to research. The world is changing so rapidly. Moore's law to something faster, right? And that's very fast. Traditional research houses cannot, they are not organized now, and I don't think they will be organized for a long time, to research innovation the way it needs to be researched. And by that I mean we've got technology seeping into every sector. So every analyst really has to become a technology analyst. We don't have that right now. We have extreme specialization and very short-term focus.
And do you think that is that kind of structural issue, right? Because that's not just one firm that does it. That's pretty much industry-wide.
Yes.
Is that something that is based on a belief that is untrue? Like, so a bunch of these people who run the firms think that that's the best way to do it and they're just wrong, or there's a better way? Or do you think that there are certain advantages from that structure that maybe aren't applicable to what you're trying to accomplish? Like how do you compare that model to what you're doing?
So we are doing something different, and they are set up more around benchmarks. We are not. I don't even know what's in benchmarks, and I don't care what's in a benchmark. So if that is the goal, the objective they've set is to be as close to something that people understand and are comfortable with. If that's their objective, then they're set up correctly. If their objective is to maximize returns on capital, I think we've set up the right structure, because for a couple of reasons. One, there are 5 platforms evolving at the same time today, technologically enabled platforms that are going to scale to the multiple trillions of dollar range, from maybe billions now.
Because one of the things that, and the reason I'm so excited to talk to you guys, this is one of the conversations I'm probably the most excited to have. You're not a crypto investor. You're not a blockchain investor, right? You look very much at the macro landscape of disruptive and innovative technology, and you come at it from a world where you've identified these 5 platforms that we can talk about, but you don't look at it as the technologies are siloed. You actually look at how they overlap, how they interact, integrate,
how they're converging.
And so maybe let's start with what are the 5 platforms, and we can kind of go through each one of them, and then we can get to, how does that actually manifest in the interaction or the integration of them?
Right. So technology seeping into every sector, and then these 5 platforms converging. These are phenomenal opportunities, but traditional research is not set up to capitalize on them. So the 5 platforms are DNA sequencing. So now we are going to bring real science into healthcare decision making. We're going to have information we can act on, like, from this physical exam to that physical exam, these mutations surfaced. Mutations are the first sign of disease. Okay, what can we do about that? All right, CRISPR gene editing technology. We can correct those programming errors and potentially cure this disease or this emerging problem.
It's funny you say programming, because it leads me to believe you probably think humans are just a different form of a computer, right? It is.
I mean, that's how we
there's
are.
There's code, right?
3 billion pieces of code in our DNA. Absolutely, and any one of them can go haywire. We can have a mutation, and wouldn't you like to be able to correct a programming error? That's what we usually do. Well, that's the science that's emerging, but it couldn't have emerged without the sequencing technology, first and foremost. So that is the major, that's the foundational platform.
Yeah.
Then you've got off of it CRISPR gene editing and CAR-T technologies and so forth. So DNA sequencing. Robotics. A lot of people think, okay, robots have been around a long time, and they have. Industrial robots are primarily in mature industries, like autos. Very mature. Auto sales have peaked, we believe. So, however, collaborative robots are surfacing. Teradyne is the biggest manufacturer, has about 60% market share, which means these robots will drop to about $10,000 per robot. And
what does a robot like that do?
It will, an assembly line worker can train the robot to do his or her job, like pick and place. They can do 24/7, no bathroom breaks, no vacation, maybe occasional maintenance. But a lot of people say, this is terrible. This is going to kill jobs. And the history of technology is there's displacement. That is true. But technology always creates jobs. And we've got a few pieces talking about that up on our website at ARC-Invest. So collaborative robots are going to enter every industry. And so we're pretty excited by that. And love the idea that most people don't even know what a cobot is. And certainly don't know the company that manufactures these, because it's a semiconductor test company.
So I think a lot of people know what a robot is, and they might have different variations of that in their mind. But a collaborative robot, is the collaborative word descriptive of the ability for humans and robots to collaborate together?
Exactly.
Okay, so that's the training element.
Absolutely. Training and helping, leveraging the humans' capabilities. Right?
And it sounds more, there's augmentation in the beginning of the human, then there's eventually duplication and eventually replacement of the human, and the human can go do something else.
Higher value add, always moving higher value add.
Yeah.
Right?
It's funny you talk about the jobs thing. I believe that this is correct. So I've had multiple people tell me this. When the ATMs came out in the banking industry, everyone's like, we're not going to need bank branches, right? The bank teller is absolutely done.
Yes.
There's more bank tellers today than there were before ATMs.
Absolutely.
Right? And so to your idea of it creates more jobs, it actually increases the access, the adoption of the banking system, et cetera.
Right.
I think there's plenty of examples that we could go through.
Yeah. Yes. And we always, when we hear that fear, we say, okay, listen, the tractor. If the population in the United States had been as large today as then, what we would have seen, the number of jobs lost would have been, for that time, remember we were agrarian, about 40 million in today's terms. 40 million jobs. Wow. Now, yes, a lot changed, and if you look back in the late 1800s, early 1900s, there was a lot of social uncertainty, and there was nervousness and unrest. But as it turned out, we ended up the end of that period, after the internal combustion engine, electricity, and telephone, the last time we had multiple innovation platforms evolving at the same time. We have 5 now, we believe, back then. We ended up in the roaring 20s, right? So boom. And if you look back then, it explains all kinds of things that are going on right now. People are worried every day about the yield curve. Well, guess what? The yield curve was inverted half the time when the economy was booming with innovation. And we can talk about that, but it's the underlying deflationary impact, good deflation of innovation.
For sure. So we have DNA sequencing.
Robotics. And we throw into robotics other automation like 3D printing. So
okay.
That's the third major platform is energy storage. So this is where Elon Musk comes in. And he really has accelerated the cost declines in battery technology. And not just the battery cells themselves. It's more the battery pack system. Do you remember when Elon first proposed his electric vehicle, and he was going to line the bottom of the car with cell phone batteries? And do you remember how many people made fun of him, including other automakers? Okay, he did it. It worked. No one else is doing it. They didn't think it was possible. He has a huge competitive advantage. He's also accelerating the cost curve decline or perpetuating it so that by the early 2020s, an electric vehicle, the average electric vehicle, will be cheaper than a gas-powered vehicle. That's probably 2021 or 2022, not too far. What you don't hear say, but we should say more, is that the electric vehicle price will continue to fall while the internal combustion engine powered car price will continue to move up. So
you think there's actually opposite effects happening? You think the electric car, I think most people think, okay, it's going to continue to go down over time, but you think that the gas-powered cars will continue to increase in price? What drives that?
What drives it? You get the emissions scandal like we saw in Europe. You get tighter regulation around the world, so that more regulation means higher costs. So that's one of the main ones, plus raw material costs. They don't have, it's a mature technology. They don't have a technology cost curve to fall down. It's mature. So we think that by the year 2023, there will be, assuming we have the batteries, the demand based on the price of an electric vehicle for electric vehicles will be 26 million units. Last year it was 1.3 million. So 20-fold increase in 5 years, right?
If that happens, it'd be good to be building electric vehicles.
Correct. And we would predict a lot of destruction in the traditional auto industry. We think most of them will go bankrupt or consolidate, or they'll insinuate themselves into an autonomous taxi network ecosystem. For example, GM has cruise automation. It's partnering with Lyft. Waymo, I think, also has a partnership with Lyft. I know there are a lot of confusing things from an ecosystem
It's very incestual, I think, right?
Well, they're trying to figure out how they're going to survive. Is basically what's going on.
And do you think that those efforts that because actually, I've never actually thought about this, but the automotive industry is very analogous to the crypto industry in that you have banks and legacy financial systems. You've got legacy automotive industry, and you got these new challengers, new technology, kind of different view
completely
of the world.
Dismissed.
Yep.
Dismissed.
People laugh at it at first,
Laughed.
all that stuff.
Yep.
In crypto, we're now starting to see, JP Morgan, they want to issue their own coin, right? We can get into all that. But in the automotive industry, how serious of a competitor in the marketplace are the legacy automotive companies that are doing electric, I'll just call it initiatives. Now, some of them are building cars, some are doing more around automation, whatever, but just how serious are those efforts compared to the upstart challengers?
Well, they're becoming much more serious because you're getting Toyota, the head of North America, Toyota, talking about Prius sales being down 9%, and they attribute half of that decline to Tesla.
Wow.
Right? So you've got some of in Germany, you've got the Ministry of Trade has come out and said, okay, we have to start supporting these new technologies so that German industry is not left behind. And we think they're talking primarily about the auto industry because it's in trouble. It's in trouble not just because of the emission standards, although I've been thinking the emission scandal is going to force them to change the subject and maybe pivot more aggressively to electric vehicles than our auto manufacturers have. And to some extent that's true, but I think everyone's running scared now. And the question we used to get about Tesla all the time was, wait a minute, these companies' R&D budgets would run circles around Tesla sales, its revenues. And our answer was, wrong DNA. For the world we're entering into, you don't need the kind of hardware engineers that these companies have. You need more electrical and software engineers, which are in short supply. So we should always take competition seriously, and especially from the old guard, because my experience investing in disruptive innovation is the old guard, in order to stop the new guard, will say, and this goes back to your JP Morgan question here, will say, hey, we're going to do that. We're just going to do it
our way, and
it's going to be so much cheaper, and we're going to wipe them off the face of the earth. That is not a sustainable company. So that now I think we've passed that test with Tesla. But that you do know that was a lot of last year was exactly about, is this a viable company? And
it's also push versus pull, right? Like entrepreneurs that are disruptive bust their way into an industry, right? They say, I'm going to go build this, I'm going to improve this, I'm going to disrupt this. And it is very self-motivated. Whereas the incumbents tend to be very pull-oriented, and they're like, I'm getting pulled into doing electric cars. I'm getting pulled. They for the most part, don't desire to do that, right? They actually loved the business model they had.
Right.
It was fine. They're making lots of money. Same thing in finance, etc. Okay, so we've got DNA sequencing, robotics, energy storage, fourth platform.
Just on Tesla, I'm going to answer one more reason it is pulling away from the pack.
Okay. Oh, I'd love to hear this.
There are three major reasons. One, it has the lowest cost battery, and it is accelerating the technology changes in battery technology, so that it's at least 3 years ahead of any other auto manufacturer. It's the only one building batteries the way it has, leveraging off the consumer electronics industry. Everyone else is using prismatic batteries. They're using cylindrical batteries. So they're riding down a cost curve that was set a long time ago. Number two, they released their own artificial intelligence chip this summer, right around the time of the famous tweet. So in our scoring system, the management score went down a bit because, yes, we do not want distractions like this, especially not with the SEC involved. But another one of our scores, barriers to entry, or moat, went up because this AI chip, which on our podcast last week Elon said had 20 times the power of the NVIDIA chip that he was pulling out. 20 times.
And we were talking about, just so people understand this, because not that many people are familiar with electric vehicles, and I frankly am a complete novice compared to you, is they were using a component, this NVIDIA chip that they were sourcing, putting in the cars. And while using that chip over the last couple of years, they've actually created their own proprietary chip.
Yes.
And they have now executed the ripping out or the cease of use of the NVIDIA chip, and they now have their own, and that's what you're talking about.
That will take place later this year.
Okay.
But our analyst who worked at NVIDIA for 9 years, he took a look at the specs, and he said, this is going to put them 3 years ahead of any other auto manufacturer when it comes to the artificial intelligence or deep learning or neural networks that you need if you're going to host an autonomous taxi network platform. That's what Tesla is going to do. And what powers an autonomous vehicle is artificial intelligence. And then that takes us to the third reason Tesla is way ahead of anybody else. Tesla has collected, and we confirmed this in our podcast last week, 8 billion miles worth of data. I think the closest is Google with 100 million, something, that order of magnitude.
Pretty serious difference.
Yes. And the competitive advantage that Tesla has is I am going out there every day in my Model 3 collecting data for them and sending it back every day. It's automatic. Whereas
so
Google's doing pilot tests.
Okay, so I was going to have two questions. One is the 8 billion or whatever the number is from Tesla, that is not simulated data.
No.
That is actual real driving on the road.
Real driving on the road.
And they have somewhat of a decentralized approach to it in that they sell cars. Mm-hmm. Those cars are driven by everyday people who have nothing to do with Tesla,
without a doubt,
other than their customer.
Mm-hmm.
And the car is collecting that data and sending it back to the company. Whereas Google, these pilots you're talking about, these are the funny looking cars that a Google employee gets in. Yeah. They autonomously drive through the streets of whatever city, but there's only so many of them. They're very kind of centralized, if you will, in terms of the way that they run the testing.
Very much so, very controlling.
It's fascinating as we're talking more how much overlap and kind of analogous applications there are for what's happening in crypto to all these other technologies.
Right. Tesla did or is doing to the electric vehicle space what Apple did to the cell phone space.
Okay,
with
explain
the
this
smartphone.
more.
Tesla is designing its own AI chip, deep learning chip, because it knows where it wants to take the ecosystem, and and knows how fast it can move, which is not at the cadence of the traditional auto industry, like 5 times faster, right? And so it had to design its own AI chip to move fast enough. NVIDIA will have the rest of the auto world that most other auto companies will build using NVIDIA's chip, and we're optimistic about that to some extent. I mean, Tesla is not going to be the only car manufacturer. Others will figure this out. So do you remember, I don't know if you had this experience. You might have been too young, but I certainly did.
Cathie and I are the same age.
So I got my smartphone, and I looked at it, and I said, wait a minute. Can I access the internet from this phone? Oh, my goodness, I couldn't believe it. I just couldn't believe it. Yeah. That was the smartphone moment. That was the iPhone moment for me. You get into a Tesla car, and you don't want to go back to any other car. There are so many are you kidding me moments. And I haven't even gone through all of the video to figure this all out. In fact, I'm embarrassed at how little I've done of that, but I'm a point A to B person, and time is money. I'm kidding, but anyway, I must study it. So they had to design their own chip in order to not only create that experience. These experiences that we're going to see from Tesla are going to be mind-blowing.
Well, he is. I'm fascinated by Elon for a whole bunch of different things, but one of the things I think even the detractors can't argue with is his ability to think from first principles. And what you're describing is, okay, NVIDIA is providing me this chip. I'm limited in the amount of innovation and the acceleration of what I want to do by that chip. I can either encourage them to speed it up, or I can just go build my own. And if I build it better, I can custom build it for what I need at a faster pace.
Which is what Apple did.
Yeah, so Apple did it. He did. Elon also did this with rockets.
Yes.
Right? Like with a whole separate business. Well, what's the problem? The rockets are expensive. Well, why are they expensive? Because you can't reuse them. Okay, what if we just build a reusable one? Well, how would we reuse it, right? Well, it's landing on a drone in the ocean, right?
Oh.
I mean, it's incredible how once he's learned that mental model and applied it and had success, he's just data point after data point after data point. He continues
Very
to do
much
this.
So.
And it's not only that they have a technology advantage, right? There's a mindset or an
completely different mindset.
Yeah, it's not even intelligence as much as it's just the way that they think, right? And that allows them to make decisions that other people probably would either think was crazy or wouldn't pursue. Right. Yeah, it's funny because there's a guy in crypto, Nathaniel, who said the other day, he said, legacy thinking is a liability.
Absolutely.
Right. And I saw that. Innovation, yes. And I literally just smiled to myself and I said, that should become a thing, because that could not be more true in terms of every industry, but crypto specifically. Right?
Well, and as you say that, what we have done in terms of research is go back to first principles research. That has been lost in our industry. All of our modeling is original modeling. And I'm not talking about the bottom-up models. I'm talking about the top-down ones, sizing. How big will this opportunity be, right? We think the autonomous taxi network platform, that market, will be an $8 trillion market. $8 trillion. Wow. Now that's out a couple of decades from now. But you can do pretty good cash flow analysis on that model. It's a software as a service model, and it's highly profitable. No one has been willing to do that with Tesla because they've been focused on this year and cash and production. But to your point, if Elon could land the Falcon Heavy, two of them on a barge at the same time, I think he can ramp production of the Model 3. That was my mantra, and people were saying, "Oh, but he's going to run out of money." And I said, "Is the equity market shutting down? He can run. He can raise money at a price. Yes, we would be a buyer at if they were going to crater the stock on that. Those are the great opportunities. We trade around those opportunities all the time.
We talked about it before we started. Amazon stock is a perfect example, right? The data points, and many of you have heard me say this before, the intra-year average drawdown for the last 20-something years is like 30+%. That means one time a year, at least, they've drawn down 30+%. And twice they've drawn down over 90%. That wasn't because Amazon was a horrible business.
Right.
It was because there was macro market, movements that caused that. There was financing needs. There's all
retail.
this stuff.
The traditional retails were going to kill them.
Of course.
Remember, I went through it with the entire time. We owned it from the beginning. So I went through those drawdowns. And when you invest in innovation, what you learn to do with them is use them, right? You use them. You lean into them. If Amazon is going to be the number one retailer globally, but let's just say in the United States, then I'm going to use every one of those downturns to increase it back to my top position.
Yep. And your dollar cost averaging the purchase of more shares, right? When everyone else is getting fearful, you start getting greedy.
And we do the opposite. When everyone starts hyperventilating about one of our stocks and takes them to the moon, we know there's another side to this, and we'll have another opportunity. And now I've gotten a lot of questions about Tesla and our trading around Tesla, because we do report our trading every day and disclose our holdings every day. In the fourth quarter, NVIDIA dropped. It's not exactly fourth quarter, but the period of time I'm talking about, when Tesla went up 53% from that moment in August when we were going through the tweet problem. It was up 53% by early December. NVIDIA was down almost 40%. I'm a portfolio manager. Up 50%, down 40%. I know what to do with that trade, especially since they're focused on the same space. Right?
There's too much of a variation between two stocks that should be somewhat correlated.
Well, NVIDIA was being taken down by crypto, so which was such a short-term reason, because it barely registered, but it did back up into the gaming, the GPU inventory.
Well, if I remember correctly, the leadership team, whoever was doing the earnings calls, they were talking more about it than it probably deserved as part of their revenue, right? It was the sexy thing. Everyone was asking questions about it, and so it kind of dominated more of a call than probably was appropriate.
So I was surprised. So they mentioned crypto positively in two calls. I get the exact quarters.
Of course.
Probably the fourth quarter of 17 and the fourth, or maybe it was the first quarter of 18 and the second quarter. And when they did, they never had mentioned crypto before because it wasn't a needle mover. So we said, okay, needle mover, that's interesting. And then they, again, in the next quarter, they mentioned it positively. And believe it or not, it is for that reason that I started taking our position down. So NVIDIA was in the 6 to 7% range of our portfolio. We took it down to a 1%. Wow. And then in October, when it started crashing, because finally in that quarter, when they announced that quarter and said, this is much bigger than we thought it was. It backed up into the gaming GPU inventory, and now we have this overhang, and I don't know when it's going to clear. So we used that controversy to build it back. Now it's back at 6%.
Yeah, and so what she's describing here is basically through the end of 17 and even into like the first month or two of 18, there was incredible unpredicted demand for GPU cards, which are used in crypto mining and also for video games and things like that. But as these companies saw that demand ramping, they basically said, hey, manufacture more. We're going to have all this demand. By the time they got that inventory ready to sell, the demand had dissipated because the price has started to drop and it had become unprofitable. And so all of a sudden you had these GPU manufacturers sitting there with a ton of inventory that they couldn't sell. And so do you discount it? Do you dump, what do you do? And that's one of the things that we think a lot about is just what is the difference between the way that a legacy business like that has to run a manufacturing process that takes time, there's a lag, then the reporting of that performance compared to the incredible speed of an iteration of crypto markets that are 24/7, 365. Bitcoin can move 6% in a day and then go the other way 10% the next day, right?
Right.
It's completely different mismatch of speed and timing.
The other thing that was happening is a lot of the new projects being announced with these new coins were being built on top of Ethereum, and so therefore GPU based.
Yep.
And we were very uncomfortable with that. Very, very uncomfortable. I've been around the track a few times. I've been in the business long enough to know if there's real speculation like we saw, there is going to be fallout and it's going to last longer. And so I'm not telling you I called it perfectly, and we would never have let go of all of NVIDIA just because it is core to us in many ways. It's not just autonomous vehicles, it's artificial intelligence, period. So we would never have but I didn't like this speculation, worried about the ICO craze, and I didn't know how badly, and I'm not patting myself on the back at all, it's just, as a portfolio manager, okay, that went too far and we don't know the last of it yet.
Okay, so let's get back to the five platforms.
DNA sequencing, robotics, energy storage. The next one is, we call it, in a broad brush way, next generation internet. So we feature today deep learning on that. And the reason we're featuring deep learning is it's ready for prime time. So artificial intelligence has been around for a long time, right? It's been great for science fiction, but we really didn't see it in our lives. It was, why is it happening now? Why are we ready for prime time? We're ready for prime time because we've taken the human programmer out of the equation. So what you need for deep learning and neural networks is you need big data. We have a lot of that. We need algorithms that will iterate as the machine is optimizing to some goal. And we need supercomputing power, right? So those are occurring. Human programmers actually held us back because they cannot imagine, this goes back to your decentralized, I know you were going to bring this thread in, they cannot imagine every eventuality out there.
Of course.
They can't. That's why open source, the movement started in the first place. People couldn't get their projects done. Researchers couldn't get their projects done. They were trying to accelerate them. So, and blockchain technology, the whole movement is exploding there. It makes a lot of sense.
It's funny because if you look at the companies that have been successful in, what I'll call kind of Web 2.0, right? So this is the Facebooks, the Twitters, et cetera. What most of them did very successfully in one form or fashion was they created a platform strategy, right? They said, Facebook said, look, okay, you guys are all going to sign up for profiles. They tied it together, right, with the news feed. So it was kind of their one competitive advantage over MySpace was this idea, real identity tied together and really lock people into the network. But when they opened up the platform, they knew people wanted to build games, right? They could have built the games themselves, but instead they said, we're going to give you the tools to build. And then all of a sudden you realize, oh, there's some person in, Wichita building something. There's somebody down the street in San Francisco building something. Somebody in New York that's building something that they want, right? And what you get is by providing the quote unquote tools to these people with the platform strategy, it's not like things that you can't imagine. The pace of the development is unmatched. Machine learning, AI, all this stuff. The part to me that the example I always go back in my head is I've been a part of some teams that frankly I probably shouldn't have been a part of in this growth side of the internet, right? So Facebook, et cetera. And one of the things that we always had to do was we had to come up with tests. So there's a bunch of traffic going to a web page, and how do I get somebody to click on this button more often? Well, you come up with 150 different variations of that button. So what color is it? What shade is it? What font? What size? Is it corner? Rounded corners, flat corners? Is there shadow? Is there not shadow? And then you take all the variables and then you run all these tests. A human had to come up with all of those variables. Yeah. A machine can do it better.
Oh yeah.
Right. It's not even close.
Without a doubt.
And they can come up with the variations faster, and they can get the traffic there, and you will get a better outcome by basically handing it over to the machines that methodically and programmatically go through that, rather than you and I sit here and try to be smart.
Absolutely, without a doubt. Yeah. Without a doubt. Einstein, so Salesforce.com's AI offering.
Great name.
It's a great name. It's a great name. They've gone from 1 billion queries per day. I think it's gone up 1 billion per quarter.
Wow.
So I mean, it's really taking off.
They're going up 1 billion queries per quarter.
It's 1 billion per day.
Oh.
And then it was 2 billion. Then it was 3 billion. I don't know if we've hit the 4 billion yet.
Got it. Okay, got it.
But I mean, this thing is exploding.
So each quarter, the daily number of queries it doubled. Then it 50%. Got it. Wow, that's really impressive. Okay, so we've got DNA sequencing, we've got robotics, we've got energy storage, we've got next-gen computing.
Which is deep learning. And technically, some people point out to me that blockchain technology should be part of the next-generation internet. I mean, it is true that the internet was not conceived with commerce in mind, just information. I was listening to Steve Case at a conference recently, and he said, I didn't know this. I didn't remember this, even though I was investing at the time. It was not legal for consumers to use the internet until 1991.
Wow.
I was in the business at that time. I had just started managing money, right? It was not legal until there was some telecom act passed. That's crazy. That's how recent this is. Yes. So back then it was academia, government, it was probably secretive, some of it.
All the bad people were using it, and all the government
porn
stuff.
as well, and all of the things.
Sounds just like crypto today, right? It does. All the bad people are using it.
All the bad people are using it. So of course it didn't have commerce in mind at the time. Nobody even conceived of it. And so now we're filling that vacuum, and it's a great thing.
And it's funny too, because there's a kind of yin and yang, I think, in the internet's development of 91. Let's say the consumer now can use this for commerce. All of a sudden you start to see better user experiences and interfaces, right? Then you see the consumer start to want to do other things, right? And then you see improvement there, and you get this kind of, the users want something, and then it takes some time for the infrastructure to catch up, right? Then the users want something else, infrastructure, like crypto and blockchain is following this to a T.
Absolutely.
Everyone wants to do certain things, infrastructure's not there. Infrastructure catch up, we go again. Why do you guys take, so the fifth platform is blockchain. Why do you take that out?
No, you mean away from next generation? Because we think it's going to be, it represents such a profound change that people just do not understand. People do not understand, and Yassine El-Mandra, our crypto analyst, who took over from Chris Berniski, Chris handpicked him, he surfaced a number that I think, it exploded it for me in terms of importance. Last year, there were $1.4 trillion in transactions over the Bitcoin blockchain. Now, and each transaction, the average size of the transaction was $15,000. So I get a lot of people coming back to me and saying, yeah, drugs and all of that stuff. No, there are other darker, less transparent places to maybe do that.
Send all the haters my way. I'm very well versed in how to deal with these people.
Yes, no, this is business to business in Africa. Mm-hmm. It's impossible to convert from one currency to the other. Mm-hmm. You have to go through the dollar. You have to pay tolls. They're 8 up to 25%. Mm-hmm. And this is a huge unmet need. No financial infrastructure. Mm-hmm. So that speaks volumes. You've got PayPal at half of that.
Oh, we go right down the line. You've got PayPal, Venmo, Apple Pay, right?
Oh, yeah.
You go through them all. The Bitcoin network, the transaction settlement network, I think the last number I saw was over 410 billion in 2018. So through the downturn, et cetera, $410 billion of annual transaction volume blows those other ones away. It's not even close.
So Yassine, maybe we should compare research, because Yassine's number is $1.36 trillion.
I like that number even better.
Yeah. No, and he can show you. He can show you that. So when I saw that, I was thinking, well, wait a minute. Visa is not even an order of magnitude greater, and we know that, especially if we were to get the ecosystem settled down, which it seems to be doing. We know it's, this is just the tip of the iceberg. That was last year. I believe that blockchain technology today is where the World Wide Web was maybe in the early 90s, maybe earlier. And if I had seen transactions worth $1.3 trillion back then, at that time, I said, oh my gosh, this is huge. This is going to be. Even today, I find it hard to believe. But the fact that has taken place tells me, yeah, there's a lot of turmoil in the world, huge unmet needs. We've also done a lot of work on mobile payments. So this would be Tencent, Alipay. For sure. So China accounts for 92% of all mobile payments in the world today. China's economy is $13 trillion, their GDP. What do you think the mobile payment volume in China is, or was in 2018? So their GDP's $13 trillion.
I'm going to cheat because we just talked to somebody from China, and they told us that it was such a big percentage. I'll go with half.
How about 2 times, 24 trillion? Now, why is this? Because GDP only measures activity. If you go from raw materials to work in process, okay, that's one number. And then say in the next quarter you go from work in process to finished, only that stage gets into the GDP.
From work in
progress to finished goods. Okay. But the entire value of it has to go through the mobile payment system, right?
Got it.
Right? So, because it's going from one producer to another to maybe the consumer. So what we're talking about here could be multiple trillions. Mobile payments themselves. This is the precursor to an ever better solution in blockchain technology. That could be multiples of global GDP. Global GDP is about $83 trillion now. So we're talking about $250 trillion. And then you also have to include tipping, which we don't do, and red envelope day, gifting in China that they do. So I think that the numbers out there that will be attached to this ecosystem are far beyond what anyone is thinking right now.
It's so funny to hear you say this because you're saying something that I think a lot of people who are looking at this one point in time are like, what the hell are they talking about? But if you kind of zoom out on the timeline of disruptive technology, we have seen this over and over and over again. And so let's go back to Uber and Lyft. When investors first saw those companies, if they were looking at the total addressable market, well, what do they do? Well, what's the taxi industry?
Yes.
How many people have given up their cars to now use ride sharing? and then you get into autonomous taxis, and you just get this whole thing. It is a market expansion type opportunity. I think that blockchain is fits that to a T. Yeah. Now, so 2 questions for you. One, let's go to Elon, because we talked about him a little bit earlier. Okay. You recently had him on your podcast.
Yes.
And he made a whole bunch of different comments. One in particular, I think, caught a lot of people off guard, but excited the crypto community, which was, he said, paper money's going away, right? How do you guys look at blockchain and cryptocurrency in the aspect of some of this there is wind at the back of crypto and blockchain, right? Lots of intellectual capital going in. People are building really interesting things. There's some adoption going on. But there's also wind in the face of some of the legacy, central banks, inflation in some countries. There's almost this opposite effect happening to 2 separate parts of the market that are net positive for crypto, et cetera. And I think he was talking about crypto is going to be successful, but he focused actually first on paper money's going away.
Yeah.
Talk about that.
I found that really interesting. I just found it fascinating. He called Bitcoin blockchain technology a brilliant, what was
design,
the word? Design or structure or something like that. Hey, I pay attention to him. That my confidence level skyrocketed when he said that, just because I take him very seriously. He's a very serious scientist, first principles all the way. That spoke volumes to me. In terms of the money side of it, he probably, as an intellectual, and he certainly is that, has focused on this idea that even fiat currencies, we lose 80% of our value every, few dozen years. And so that's just wrong. That is, how can I change the world kind of thing? Well, that's how he thinks anyway, so let this change the world.
It is, it's one of the most misunderstood aspects of crypto, in my opinion, let's talk about Bitcoin specifically, the deflationary nature of true sound money, right? That is not governed by a sovereign nation, that can't be printed, all this stuff, has the ability to attack the number one cause of income inequality in the world, which is inflation. And when you start
very regressive tax.
Yeah, and when you start to go after that, just that alone would be a huge deal.
Yes.
And then you layer in on top of it the programmability of money, you start to almost be overwhelmed by how big of an opportunity. And
how profound.
Yeah, and before we started, I think this is across all 5 of the platforms, it's more likely that everyone is underestimating each one of these than overestimating.
I couldn't agree more. So I went through the bubble, the internet bubble, and
You're fine. You're okay, right?
Yeah, came out alive. Yes, and learned a lot of lessons, and know what a bubble is really, and we're in the opposite of that right now. We're in the land of despair, as far as I'm concerned, in terms of innovation.
Okay, explain that more.
What that means, I feel if you've studied S curves, you have, or Carlotta Perez's work, you have the eruption and frenzy stage, then you have the too much capital chasing too few opportunities too soon, and you have the fallout. So that was the early 2000s. And I think because of 08-09, that fear of ever going back to the late 90s was reinforced then. Except it was housing, but there was that, this is what happens. And I feel as though we still are in the valley of despair. People laugh at me when I say that I believe we are running deep value portfolios. You have to give us the right time frame. If you look at the multiple on our portfolios, the PE ratio based on today's earnings, 60, 70 times, out there. That's because we want our companies to be investing aggressively now, because these opportunities are so big. So we are quite happy that they're doing that. As long as we agree with the strategy and we can see a minimum 15% compound annual rate of return over 5 years on average. So a doubling over 5 years.
Got it.
And that's a minimum, all right? we can see if the Tesla one got a lot of press because our bear case is 700. I think it's at about 300 today. Mm-hmm. That's our bear case, and it meets our minimum 15% compound annual rate of return. Bull case is 4,000. Everyone thinks that's crazy, but if I gave you the assumptions behind that, I will tell you, given the way we think how the world is going to work out, that is a conservative bull case for Tesla.
So you're going to love this. We have not talked about this before, so this is exciting to me because one of my theories in crypto, the reason why so much innovation and interest is coming from the millennial generation is that they were told stories in their early teens and mid-teens about the internet bubble. They did not experience it. They weren't aware. I'm dead square right in the middle of that demographic. And then we went through the housing crisis and the global financial crisis, and we're just aware enough to see what happened, know that there was a lot of people who did irresponsible things, probably see either our families or people around us be affected in a very negative way, but not have enough assets to actually be personally affected. And that left a bad taste of distrust in everyone's mouth in that generation. And now all of a sudden we're moving into a world where somebody has come along and said there's a new piece of technology that not only allows you to do the same things that people have always told you that you could do, you don't have to have the false trust in those organizations. Right. My parents never thought a bank would go out. Right. Never. That would be unfathomable.
Oh, yeah. No, I know.
And then that was my experience growing up. Of course. Right? Of course these banks could fail. Anything could fail, right? Yeah. And so it feels to me like not only does innovation happen from earlier stages, et cetera, the stat that recently came out, eToro did this study, and it says that 43% of millennials that they surveyed trust the crypto exchanges more than traditional stock markets.
Oh, well, Chris Giancarlo at the CFTC, I'm sure you saw the testimony. His first testimony on this in front of some committee, he was with Jay Clayton at the time. He said, okay, I got to get this right because I tried to inspire my children to invest in equities and bonds when they were in high school, and they just never had any interest. Now they're in their 20s, they're on their own, and they're coming to me asking me about this asset.
About cryptocurrency.
About crypto assets generally. And so what I liked about his testimony is he believes this is real innovation and is to be taken seriously. Do no harm, I think, is the philosophy. But it was his children, and just like Jamie Dimon's daughter finally got him to stop bad-mouthing at least all of the cryptos. But I did want to say one thing. One of the reasons I'm so excited about this movement is I was educated by Art Laffer. Art Laffer, many people know him for the Laffer curve, which is a fiscal policy concept, right? Which is if you increase taxes enough, you'll get less in the way of revenues because people will just not work or move or whatever. But he is a global monetary scholar.
Okay.
His mentor was Robert Mundell, who won a Nobel Prize for economics. And we collaborated on our first Bitcoin paper together. So ARC was the first public asset manager to gain exposure to Bitcoin in 2015.
Okay, so this is going to be one of my questions. Explain what you guys did then and what the logic was at that point, and then we can talk about what you're doing today.
Sure. So what we did is Chris had joined the firm. He was next generation internet analyst.
Okay.
And our director of research, Brett Winton, and I, but Brett more so, he was onto this well before I was. We were saying, okay, let's just see if it could fulfill the roles of money. And I said, let's get Art Laffer to write that paper with us, because he's a professor, and he will not let us get away with anything. So we were, I'm not saying we were skeptical or not skeptical, we were just trying to figure out what this was. Could it serve the roles of money? And we wrote that paper with Art. Art never put his name on any other paper associated with crypto anything. So I'm really proud of that. But he was my professor at USC and really tough, really good, really tough. And he put us through the ringer. I mean, we had to think about this. So I was going back to my, he was in the graduate school at USC. I was going back to those classes and, you know, just really drilling down and making sure we had our T's crossed, I's dotted, and all of that. When we finished doing that paper, I said, I said to Art, Art, how big could this be? And he said, well, how big is the U.S. monetary base? And at that time, it was $4.5 trillion. I said, whoa. So it was through that period we were also watching, Greece was threatening to leave the euro, and we were watching Bitcoin settle on its 200-week moving average. And you know, just because Bloomberg comes equipped with these lines, I look at them because everybody looks at them. So okay, look at them. And but we were watching, and I was watching how it was responding to the news on Greece, and it was starting to respond. And so I said, okay, let's do this. And so we put it in the portfolios in September.
Okay. Do you remember what size position you guys did?
We were only allowed by the regulators to put in a 1% position.
Okay.
And we let it ride. We didn't. So we said, okay. We didn't say we'd keep it there. No. Don't tell anyone. No, I'm kidding. I'm kidding.
and so when you purchased it, did you go?
No. By the way, we never did buy any more. We let it run. We never sold any.
Yep.
So it got up to a
10%
10% position.
And it ran.
And we could not hold any position above 10 position in that was delivering unqualified income. So that was, and especially because it had started forking, and we were getting these unqualified income questions. So we needed to, fiduciary, had to make sure, when we did take the size down, it happened to be good timing. It was around the peak. We took it back down to 1.
Got it. So it's now public that we raised some money from some public pensions to go into the crypto space. So the first 2 to do it. We also got some money from a hospital system, an insurance company, and things like that. And the conversations that we found most, or kind of had the most traction, were not about crypto. It wasn't about decentralizing the world, burn down Wall Street, any of that kind of stuff. It was about, you have an asset that has low to no correlation, has an asymmetric return profile.
Without a doubt.
If you believe in modern portfolio theory, you probably should put this in your portfolio, right? And here's all the impact and the benefits and some downsides and all that. Did you guys think through that?
Yes.
Or was it more of you're making a bet on the growth of the asset?
No, we thought through it. Now, so our first paper was, could it serve the role of money? Okay, that was the first paper. We didn't talk about our research ecosystem earlier, but our research ecosystem is very open, and we were pushing that paper out. And we were only a year old. I mean, fledgling.
Yeah.
And Coinbase reaches out to Chris over Twitter, because we were pushing our research on Twitter and LinkedIn and Medium, wherever we can.
You actually were dropping pamphlets off on the sidewalk outside before you came in here.
Wherever we can engage with the communities we're researching, that's where we want to be. And we want them to see our research. We're the first sharing economy company, we believe, in the asset management space when it comes to research. Here's the payback. In 2015, Coinbase DMs Chris, and they get to know each other a little bit. Then Coinbase proposes to Chris that we, ARC and Coinbase, write a white paper together about this new asset class for exactly the reason you just said. And Chris comes back to me and says, this is what they want to do. And I said, why do they want to do that with us? Why don't they go to Goldman or Morgan Stanley? Goldman's going to want to do their deal when they IPO. Why us? And it was, and this is what transparency does. It's because we have real credibility. We wrote that paper. We were validating it when most of the traditional financial community was considering it, or considering the possibility it could be a Ponzi scheme. We come out and say, no.
It's real.
It's not.
Yeah.
And that paper was called Bitcoin, Ringing the Bell for a New Asset Class. We could not have written that paper without the data that Coinbase gave us. So this research ecosystem that we have evolved, sharing economy, it spoke volumes to me. It worked so much better and so much sooner than I had anticipated. That was a very important moment for us.
So I really want to talk about this because this is me being selfish and learning from you in something that's directly applicable. I've thought a ton about what is wrong in the asset management business, less about people being inaccurate in investing and things like that, but more about the company building side and how many of the legacy firms are built for a world that doesn't exist anymore.
You are so right.
And some of it's speed, some of it's transparency, communication, all this stuff. But what you guys have done, there's a lot of things that I'm envious of, frankly, in terms of your ability to cultivate a community, to provide more transparency than you're regulatorily required to. The way that you communicate and disseminate information and kind of give much more than you take from these communities, it has a lot of advantages. And so we're very early on in trying to do this stuff, probably taking a less research and academic side and more audience building, etc. But I'd love to hear, now that you're 5 years in and you can take that exhale and say, okay, we made it 5 years, what you've learned along the way and kind of, would you do it again, right? And kind of what those benefits have been as you've built the company.
Would I do it again? Without a doubt. I actually am hoping others do this as well. Because I believe that we are in the middle of the most massive misallocation of capital in the history of mankind. And it's called passive and indexed investing. It's just wrong.
Why?
It's wrong. It's very backwards looking. And when I was starting the company, I was speaking to a person who knew nothing about our business. And I was trying to explain to him, not being in our business, what I was trying to do. And he said, oh, so you mean the future of investing is investing in the future? Yes, because that we've lost the plot. When I started, and I started when I was in college in the late 70s, there were no computers.
Me too.
So there were no computers. No one had a computer. No one had, certainly no cell phones, nothing. Information was scarce. I worked at Capital Group on the West Coast, just a wonderful institution. And I remember my first meeting, I was sitting with the economist, because Art Laffer introduced me to the company. Thank you, Art, again. I was listening to a group from Asia and the US and Europe talk about Hong Kong. This is 1977, about Hong Kong 1997, 20 years later, when the changeover was going to take place. And I was saying, oh man, I want to be a part of this business. I want to do this. I want to understand how the world is going to work. And so that's why I joined. And back then, going into companies, it was so hard to get information that there was a real role for those company visits and going to conferences and everything. Now the information is just out there. And by the way, they can't tell you anything they haven't told everybody else. So you can't, it's not like inside information was okay back then. It was the only way to invest, was to try and get some information to bring perspective.
Well, the information edge was available with the company's information.
Absolutely.
Now that's been taken away by regulation, and the information advantage has to come from non-company sources.
And so from our point of view, the information advantage is in doing first principles research, again, not being done. Many people ask us, who else is doing what you're doing? No one else is doing what we're doing. If you look at our models, we now have autonomous taxi network models 5 years old, and they're evolving. And we see the price of autonomous travel coming down as other prices come down. So we have autonomous truck platoons, we have drones, we have passenger drones and parcel drones and so forth. We've done all that modeling work. And the aha moment for me on this, in terms of you're doing the right thing, was when in 2014 we put out our first drone piece where we said, Amazon could deliver a 5-pound package over a 10-mile radius for $1 profitably today if the regulators would let them. That went out, and here we were, this little peapod of a company. Maybe we had $20 million, probably not, under management. And yet Silicon Valley ran with that because they hadn't seen that work before. So we're doing that kind of work and trying to help people understand how big these opportunities are, and maybe even help regulators, hopefully, understand as well. Our research is getting into I know we've done work with the Port Authority here in New York and in New Jersey, so it's starting to get out there because we want people to understand, this is going to save lives, or this is going to save money. The best thing that can happen for us, this is going to sound odd, but is a crisis. And it's always the best thing for innovation. It's usually when innovation takes root and gains traction. So in 2008-09, when chief technology officers were told by their CEO and CFO, cut your spending another 20 or 30%. They had been cutting since the tech and telecom bust. They couldn't cut anymore. What did they do? They stopped using the enterprise level licensed software and went to pay-as-you-go. So while most technology companies saw their revenues drop 10, 20, 30% at some point during the period, Salesforce.com's worst quarter of revenue growth was 20%.
It's incredible.
It is incredible. So that's why we lean aggressively into our highest conviction names when there is a crisis. So we concentrate more while others are diversifying more. We concentrate because we know that these companies are going to gain traction and take off.
Well, and there's a lot that goes into that, right? It's like, I think it's the Warren Buffett quote where he basically says, diversification is for people who don't know what they're doing. Right. And so like, when there's a bunch of fear and people are kind of got whiplash and, oh my God, the world's ending, that's what you do, right? You go into preservation mode, you go into defense, and
you go to your index.
You
go to your index.
Absolutely. And
by the way, that is not what you should do in our view. Don't want anyone to confuse that.
And instead, the companies that are going to survive, right? So you got to be right on the companies that are going to survive. But if you are right, if you actually can build highly concentrated positions in those times, it will pay off when you ride out the market.
Hugely.
Right?
That is the secret to our outperformance over time. I always say when we're in the middle of a, shall we say, turbulent period, fourth quarter was a bit that, and our analyst team is young, very young, because they have one foot in the new world. They've been educated in these areas, and they're passionate about pursuing them. And so they've not been through very many bad markets. And I'll always say, okay, you got it. Well, first of all, very calm. Okay, this is when we're going to. This is the period that's going to determine how much we're going to outperform going forward. So let's concentrate. Let's huddle.
It is. It's funny to me how investing is very similar to sports in some ways. In that, if you look at all the great college football coaches, right, and NFL coaches, many of them, there's these videos online, and when things are going bad, they're kind of somber. When things are going well and they're scoring a touchdown, they're somber. Right? So Bill Belichick with the Patriots is a great example. Like, people are excited when they catch him on video smiling. Right? like he's pretty even keel, good times, bad times, right? He's just kind of, hey, we're here to do a job. And investing is very similar in not only the bear markets, it's also in the bull market.
Absolutely.
Right? And you guys, probably more so than others, talk about you sell into the bear market or into the bull markets, right? So maybe talk about how you think about the bear market is probably talked about too much, right? Oh, if you can get greedy when other people are fearful, etc. But going into a bull market, I think that's actually when people lose even more discipline because they get really greedy.
Right. And so what we do is diversify into a bull market as it extends, because we're usually involved in stocks where, if people do get it, the stocks do take off. And I've been again around the block a few times. I know what is too much. Even with Bitcoin as it was levitating, it was interesting. I was even kind of examining my own thoughts about this, like why haven't you taken more profits? Why aren't you doing that? And part of it is we were trying to figure out tax ramifications. So we were thinking about it throughout the fourth quarter of 17. And we were trying to manage around it. But where we didn't have a tax consideration, other accounts, we did take it down by half.
Okay.
We took half of our position out in December. Actually, it was December. And there we left it. So we took it down to a 4.5% position. Now others would have said, well, that was pretty stupid. We didn't add to it as it was going down, but we did add to it as it got to sort of 6,000 and then 3,000 were the milestones we were waiting for. Because I just, who knows where it's going to turn? Just no idea.
We could talk about this for hours. One thing I want to go back to is, so we went through the 5 platforms, right? And we started off talking about how most firms have very siloed approaches. So if you're into DNA sequencing, right, and kind of the healthcare life sciences, that's what you study, right? And that's what you look at. If you're into robotics, battery storage, all this stuff, you look at a lot of things that don't fit in those buckets. So you've identified 5 platforms, but you've talked quite a bit about autonomous taxi networks. So maybe let's talk about that specific application of multiple technologies and how you, one, just describe what that means and kind of how, why you're excited about it, et cetera. But then 2, how do you use a fairly rigid framework of 5 specific platforms to look at a application of those technologies that doesn't fit in any one 5, right? It's kind of a blend across multiple ones.
Right. It's the working assumption that these platforms are converging.
Okay.
So if you have, if you're setting up a company like this, and that is your belief, what you will do is create a very open atmosphere. So I'm right in the middle of all the research, and we're all talking to each other, listening to each other. Because very often what one analyst is saying, even in the genome space, you'd be surprised how much artificial intelligence is impacting that space now. It is, when you combine that with DNA sequencing, which is the source of the data, and artificial intelligence and computing power, there's some mind-blowing stuff going on. And it's just really fun to hear about that. So the way we're set up is, every day we have a morning meeting because there's always something new happening. And
Elon might come on your podcast and say that paper money's going away.
Yeah. And so
you have a morning meeting.
Every morning where we're just batting back and forth, just news items, anything that came out that's relevant to anything that we're doing, right? And that sometimes will spark discussion. So I won't do anything, usually, no meetings until earliest 10, maybe 10:30. So from 7:30 to 10:30 is when we just really power down, because again, the world is changing very quickly. So that's the first thing. We also have a brainstorm session. You'd be more than welcome to join us every Friday from 1 to 3.
Okay.
And that is where our analysts, under the leadership of Brett Winton, our director of research, the analysts submit to Brett the most interesting or provocative or controversial ideas they've heard all week, or the biggest breakthrough they've had in their own research.
Oh, interesting.
Yeah. And then we will put that out for brainstorm discussion. And so Brett and I are involved. All of the analysts are involved. Whereas in the morning meeting, some people, it'll pique their interest, and others. This is a really concentrated, hey, let's see if we can come up with some aha moments. That's what I call them in here. So in 2014, when NVIDIA is being thrown out of most portfolios because it was a PC proxy and nothing more than a PC gaming chip company, Tasha Keeney comes in and says, she's charged with building the model for our autonomous taxi network. Well, first we need an autonomous taxi, right? So autonomous vehicles, it looks like GPUs are going to be the brains or the central nervous system of autonomous taxis. And I'm sitting there saying, Tasha, Are you sure? No one knows that. No, I've never heard anyone say that. No one out there is talking about this. And she said, yep. And then we went through the research. And then James, who's in the same meeting, he's out of NVIDIA himself. And he says, well, that makes a lot of sense because NVIDIA or GPUs are essential for the training side of artificial intelligence. I said, okay, James, you know that because you worked at NVIDIA and you see the pipeline, but I guarantee you the financial markets do not know this. Mm-hmm. And so we felt we had a leg up right there. Mm-hmm. And NVIDIA went up the size of NVIDIA went up in our portfolios, and it entered other portfolios. Mm-hmm. It entered our industrial innovation portfolio, for example. Mm-hmm. So the collaborative nature of the way we're set up physically and what we do in terms of setting our various meetings up, we have a research modeling session. So I'll come in and see how the sausage is being made on Thursdays. Mm-hmm. And that's where we meet with, Brett and I meet with each of the research teams. Each one takes us through the latest development in their modeling. Now I'm not there every week because it takes a long time to make this sausage and I can catch up pretty quickly. But I would like to do that because that's the source of my confidence, right? Mm-hmm. There's a lot of people say, wow, you're so brave. And no, it's the courage of conviction born out of great research, great mm-hmm. original first principles-based research, which there is not that out there anymore. The biggest surprise to me, I thought venture capital firms did this. I did until I started the business. Now they want to partner with us, which is really interesting and gratifying. And we're happy we do have...
I'll tell you the secret that you probably already know. Venture capitalists are the biggest sheep in the world. Oh. Right? They will FOMO in, right? And look, it is... I have a theory that I want your opinion on, actually. The more that there is consensus excitement about an early stage company, the less interested I immediately am.
Same. We've been asked if we will enter the venture capital space. Mm-hmm. And I said... only under one condition, that we only buy into companies that nobody else is excited about. They have the right technology. We have been looking for a company with that technology. Mm-hmm. Maybe they don't have the most charismatic CEOs or whatever and can't schmooze, but they have the right technology. We just have to make sure the right business leaders around them. I could see doing that, but I think the biggest excesses, the bubble today is in venture capital and in the private markets, and mm-hmm. really I don't want anything to do with it right now. I want the allocation of capital. If you look at the misallocation of capital, you look at, in the 3D printing space, Stratasys, mm-hmm. It's about, maybe now it's about 2 times sales. Okay. Formlabs in the private space. Mm-hmm. Last round, which means the deal will be higher than this, the IPO or what next round, 10.5 times sales.
Okay, so 2 times sales in the public market, 10.5 times sales in the private market.
That's the last round. Yep. I'm sure it's going higher. Yep. Stratasys is much better positioned because it is now being integrated into aerospace companies' engines, right? You think that an aerospace company is going to allow a startup to design a part for its engines? Pretty unlikely. You have to get battle tested over a number of years, right? Mm-hmm. It's taken a long time for Stratasys. So they're in a much better position. I don't understand this. I can give you other ones. Palantir at its peak last round was 26 times, and the bankers were going to take it for 55 times. Splunk, which is a better model, is at 9 times. Mm-hmm. So that bubble is going to end, and it's going to end badly. I don't know exactly how. I do know this. This I did not know until recently, and it blew my mind. If this really is true, I was talking to the CEO of a 3D printing company who was saying, oh yeah, we know, and that the stock had been creamed. He said, yeah, a few companies are thinking about IPOing, and we've heard about some of their public-private holders, so those holders who are maybe the big, like Fidelities or T. Rowe. Mm-hmm. I don't know who this is, so I'm not casting aspersions or anything. Yep. That they're in the pre-IPO market, but they're shorting in the public market because they know that the deal is going to go badly. It's too high priced given the valuations in the public market, so they're shorting in the public markets, even though there's this discrepancy. And you know what? I did see that play out in the RNAi space, in the genomic space. We have a company, 2x sales. The name is Arcturus. Moderna went public on December 6th at 30x sales. It promptly got cut in half, went from 26 to 13. And it hurt our company too. Our company got hurt.
The whole market comes down. What you just described in terms of the process that you run with this research on Fridays, where bring your wildest ideas, the most controversial, and throw them out there. It reminds me of a quote, innovation is born out of necessity. And what you're doing is, I think this is true. I've heard that BuzzFeed, at some point in their life, when somebody would write an article, they had to come up with 25 headlines for that article.
Okay.
And so the first 5, pretty easy. 10, okay, some variation of the first 5, right? Eventually you run out of the easy ones and you really start stretching, right? You know, and this is where you get some of the clickbaity headlines and you're really stretching. And they would take those 25 headlines and they would load them in to a system that would basically show all 25 headlines to some small percentage of the audience. And then whichever one got the most clicks, they would then blast that on the main site to everyone.
Right.
The reason why I bring this up is I forget the exact number, and I wish I remembered. I think it's like the last 5 or the last 7 were almost always, or some high percentage of the time, the ones that won when they were put into that system because they were the most non-obvious that people had to pick.
Yeah.
And so if I know that every Friday I've got to come to a research session, I might get to Thursday night and be like, oh shit, I don't have anything. Right? And I start coming up with some pretty wild stuff to bring to show people. And so it's the way that people design firms and the way that they think through the interaction of their staff and structure and everything, it does have a huge impact on the information output that you get.
And the chemistry, I mean, every time we add a person, I mean, it's got to be top of mind for me because the chemistry, and this Sig Segalis from Genomes Associates, where I was for 18 years, he used to say this. He hated the interview process because he knew that the odds that this next person, very talented, probably, you know, strong-willed, probably all those things you do want, those things can harm the chemistry and culture of an organization. So the way we do our hiring is, if we're looking for an analyst, I am not the first screen. Our analysts are the first screen. And then Brett. And then I am. And I have, again, around the track a few times, I can spot a few things that are just absolutely not. And I'm learning to trust myself more on that too.
What is the feeling? No one's ever fired somebody too quickly, right?
It's true.
All right, before we wrap up, I usually ask a whole bunch of rapid fire questions. I'm going to skip a bunch of them because they don't matter. But I have 2 questions, and then you get to ask me a question. So think through that for a second. But first question, what's the most important book you've ever read?
Okay, well, investment book, you mean?
And any book in the world.
Well, then this is going to tell you a lot about my life, the Bible, and it is. So it is, and actually still is. I go back to it all the time.
You were only the second person to ever say that on the show.
Really?
Yeah.
Oh, I'm surprised.
My hunch is that more people believe that is the most important book they've ever read. They don't want to say it. So I have no way to prove that, but that's my general take, because people usually come in and they will hit me with every book that you and I have seen go around the Olympic or the intellectual Olympics of Twitter, right? That is supposedly going to be the next thing that saves the world. All right, a non-tech question: aliens. What is the probability that they exist versus not exist?
Wow, I've never thought of that. I have to be open to almost anything in terms of what I do.
Okay. How would you work through trying to get to some probability?
I'd get Brett, our director of research, and our analyst together to say, let's think through this. Let's think through this. No, honestly, I'll ask that. This is going to be one of the topics at our brainstorm on Friday. Come.
I was just going to say I'm cheating because I get to participate without actually having to go.
Yeah.
The reason why I usually ask, I actually want to know the outcome of this is it's fascinating to hear people try to think through it and arrive at different answers. And some people walk in and are just like, answers I would never believe. Like Josh Brown believes that ghosts are more likely than aliens. So him and I haven't been talking for a while because I think he's a little crazy now. No, but it's one of these things where not that many people have ever thought about the probability behind it.
Yeah.
Right? You've seen the movie, you've seen all stuff. And then I usually ask, what is the probability that aliens have pets? Because a lot of times in movies, we think of the other intelligent life as just a human comparison.
Yeah.
Right? They show up, right? They're like slimy, maybe a little shorter, weird head shape, whatever. But are they actually multi-species, type intelligent life out there? Probably.
As I said, I have to be open to anything, and then we do our first principles research.
All right. You're going to come back at some point.
Yes.
We're going to talk aliens.
We will.
Okay.
We will.
All right. What one question do you have for me?
Oh, gosh. Well, I want to know, are you leaning more towards, given what you're building here, are you love building this community, you want to educate, I presume, is this an institutional and retail investor base?
All institutional.
Okay, all institutional.
And my whole theory is that, this is the secret sauce, is we will benefit more from doing everything possible to build an industry that doesn't have direct benefit to us than we will from wrapping our arms and saying we're going to go take our ball and go play in a different sandbox.
That's why we set up our research ecosystem the same way. So that's fantastic.
Some of the things that I will caveat all of this with, we have not decided to do this. These are my personal ideas. I have no clue my partners think about this. But things that I do think are very interesting and different. What if we actually published all of our investment memos about the companies we invest in the private market? What if we publish our returns and you can literally go see the NAV of the fund? What if we were to announce in very different ways investments we made? How would founders look at that? Positively, negatively? What are the risks, right? There's regulation, there's all stuff. How do we incorporate a retail audience that's very big, that's very engaged, much more into what we're doing while still being compliant and aware of all that regulation? It blows my mind that I can pick my phone up, right? That little computer in my pocket and talk to 180,000 people and just type it out and bam, and it goes. Yeah. And then they share it with people and it goes viral. How do you take that and bring it into what historically has been a pretty private business, right? And kind of closed off? And not only how does that help us, but crypto is this weird area where the thing that unites crypto the most is actually people outside crypto attacking it. So like the Noriels of the world,
no question.
This is all a scam. Jamie Dimon, it's all a scam.
Yeah.
Immediately, everybody who hates each other immediately becomes friends, links arms, and is like, no, we're coming, right? and so how do you take that like fanatical belief and interest
and energy
and direct it towards things that I don't need to build Morgan Creek. I want to build an entire industry where there's 20 of us, 30, 50 of us, right? Because I'm only going to raise so much money from institutions, right? You guys are only going to raise so much money from retail institutions to go invest in blockchain. Like, we need hundreds at some point of people doing this. But I think that community is very undervalued and underutilized. We're fortunate enough to have it. What do we do with it? Right. And that's like the big question that I just keep coming back to. And so we've done everything from, look, we, in probably unpopular fashion, not only announced a fund, we announced who the LPs were. Now, they're public pensions, right? So they're going to be, it's going to be public information at some point, but doing that, we announced our entire portfolio. That's not very common, right? We've done things where we've literally done these like flash sales of T-shirts. And you're like, what are you fund managers doing selling T-shirts? You're missing the point. The point is there's now people walking around and they feel like they're part of the community. They feel like this T-shirt I have on is a statement of what I believe and who I am, and then they're showing it to the hundreds of people they interact with while wearing the shirt. That's a lot of stuff that has nothing to do with investing.
And they are going to bring you ideas. if you make them feel a part of your community, your ecosystem, they will give you more ideas to strengthen the community.
Look, I'll say right now, if you guys are watching, and you made it all the way to the end, thank you. But tweet at Cathie and I the wildest ideas you have in blockchain, and we'll have some fun and engage with you guys. But listen, thank you so much. This has been awesome.
My pleasure, Anthony. Thank you.
We're going to have to do this much more often.
Yeah.
I'm going to sneak in on Fridays and listen to all the wild ideas.
Without a doubt. You can video in. Yeah.
But yes, thank you so much.
Okay, pleasure. Thank you. Thank you so much.